All right. Okay. So, hi everyone. I'm Muskan Chawla, and I'm an assistant professor at the University of British Columbia. And it's my pleasure to invite Tomomi from Kobe University, and she'll be presenting her paper on R&D accounting and innovation signaling, insights from Japan's pre-regulation era. So, before we begin, just a few housekeeping rules. Please make sure that your microphone is on mute, except when you're asking questions. And it would be great if you can share your video with us so that this session is more interactive. If you have any question during the presentation, please feel free to raise your hand and Tomomi will answer it. Or you can also type your questions in the chat box. I'll be actively monitoring the chat. And lastly, I'll give Tomomi first 5 minutes uninterrupted. And after that, feel free to jump in with your questions or type your questions in the chat box. And with that, thank you so much for being here. And the floor is yours, Tomomi.
Okay, thank you. Thank you very much. So hello, everyone. I'm Tomomi Takada, and I'm a professor of Kobe University and currently cross-appointed with the JICPA, the Japanese Certified Public Accountants. And first of all, thank you so much for agreeing to adjust the presentation hours so that I can present. And I just want to say thank you to all of you for being here, despite not being in the usual time slot. And thank you to Professor Penman and Ayun for developing and maintaining this research platform. And also, thank you to Muskan for moderating this session. Okay, today I would like to share my ongoing joint research. Okay, so let me share my screen. Can you see the slide? Okay, thank you. Okay, good. Okay, I would like to share my ongoing joint research with Kazuyuki Motohashi of the University of Tokyo and Ayun Sam of UC Davis on the fascinating interplay between R&D accounting treatments and their R&D activities' subsequent innovation outcomes. The outline of my presentation is as you can see here. So until the 1970s, US firms were able to capitalize their R&D costs on their balance sheet. And it was also actually the case in Japan until 2000. Until then, there are no formal accounting standards for R&D in Japan. And firms were able to capitalize their R&D costs when they could expect future relevant economic benefits. So this setting in Japan provides us with a natural experiment to understand the firm's voluntary R&D reporting choices and their consequences, offering variable insights not only to academics but also to policymakers. So our central research questions are twofold. First, whether firms convey private information through the choice of capitalizing or expensing R&D costs. Next, how does the prohibition on capitalizing R&D costs influence the relationship between R&D costs and the type of projects pursued by firms? Okay. Understanding this voluntary reporting behavior is crucial because it reveals the underlying motivations and the signaling mechanisms when formal rules are absent. And now let's review R&D accounting standards in the past and present. And in the past, I would call it as voluntary regime. In the US, before SFAS 2 in 1974, many firms capitalized and amortized R&D costs. So it is also the case in Japan, as I said. And what is important regarding the Japanese setting is that the capitalization or expensing choices are up on a project basis. So which means that there is no clear cut between expensers and capitalizers. And as data shows, there are so many companies that both capitalize and expense R&D expenditures. to what extent they expect future relevant economic benefits. On the other hand, under the current present situation, it's I would like to call it as mandatory regime. So there are clear-cut accounting standards, and also there are very limited room for companies to choose from alternatives. For example, IAS number 38 requires the immediate expensing of research costs on the income statement while requiring the capitalization of development costs on the balance sheet. And I don't think I need to explain the US accounting accounting standards very much, but after SFAS 2, R&D costs are mandatorily expensed. And even though accounting standard for software allows companies to capitalize some expenditures, but only after technological feasibility is established for the product. So, as you can see here, there is a clear distinction between with regard to R&D accounting in the past and in now. So let me move on to the importance of our research topic. So FASB recently started to invite comments on recognition of intangibles. So which means that R&D accounting is one of the latest and hottest topics for accounting standard setters. And they provided 5 main questions, and among them, we believe that we can answer the 3 questions underlined. So what intangibles should the FASB consider addressing? What potential solutions should the FASB consider? And what information about intangibles do investors use? Okay, next, let me move on to the relevance of the Japanese setting to provide some implications for US standard setting. Okay, as you can see here, so there is a moderate increasing trend regarding the R&D expenditure relative to GDP. And as I noted here in the slide, the behavior of the trend in Japan and US is similar between 1990s to the latest situation. So therefore, given these similar behaviors, okay, so Steve, do you have question?
Yes, only if you've finished your introduction. In the Japanese setting, was it just discretion on the part of firms to capitalize R&D, or were there certain milestones set to do that? Under IFRS, there's 5 milestones before you can actually capitalize development. In Japan, were there any criteria set for capitalizing R&D, or was it totally discretionary?
So during that time, there is actually no explicit accounting standards for R&D. So therefore, companies recognize their R&D cost as expense or to capitalizing based on a very principle-based accounting rule. So which is equivalent to conceptual framework. So therefore, we understand that technically there are no accounting rules or the milestone whether or not they are allowed to capitalize R&D costs. Okay, thank you. Thank you very much for your question. Okay, so let me go back to the slide. So we could confirm the relevance of the Japanese setting to provide implication for the US standard setting. So not only for the relevance of the accounting standards, we believe that R&D accounting has economic importance considering the US setting. So while the R&D expenditure relative to GDP is in between, say, 2%, from 2% to 4%. But in terms of the economic volume, the volume of R&D has been increasing since 1953. So therefore, if accounting choices influence R&D activities or their subsequent innovation outcomes, it should have material impacts on the economy. So therefore, our research topic should be very important. Okay. So now let me briefly look at the impact of R&D accounting choices if there are alternatives. So in this slide, I'm going to explain when companies expense R&D costs immediately when it incurred. So assume that a company spends $1 billion on R&D activities in January 2022. So this accounting phenomena influences the company's income statement only at once. Okay, so if the company chooses to expense R&D costs, so which is one shot, $1 billion expense as of the financial statement, on the financial statement or income statement as of 2022, even though this project is successfully completed in 5 years. So, but if this same phenomena, for the same phenomena, the company decided to capitalize R&D costs as long-term asset on balance sheet. So the impact is toward not only to income statement, but also on balance sheet. Okay, at the beginning, the 1 billion R&D activities cost is recognized as long-term asset in January 2022, and this amortized value is amortized over the next 5 years. And through these 5 years, not only on balance sheet, but also on income statement, these R&D activities have influence. And in 2026, this project is successfully completed. So this is how the different accounting choices influence differently on their balance sheet and income statement. But what is important regarding the R&D accounting choices is when the impairment happens. So in this particular example, we assume that the company recognized the project is failing in 2024. In that case, impairment losses have to be recognized on their income statement as 0.6 billion impairment losses, and their R&D asset balance should disappear as of 2024. So in our research framework, we believe that this impairment system works as a kind of cost for companies who decide their R&D activities to recognize as asset. Okay, so let me provide you with our research setting, more specifically R&D accounting practices in Japan. Ayun?
Can I add something about the slide before?
Sure. Please do
Yeah,
so.
so the way we think about impairments here is if there's no subsequent impairment assessment, then all the firms would try to abuse capitalization by putting more cost on the balance sheet, because doing so would lower the impact, negative impact on their earnings. But with subsequent impairment assessments, the capitalization actually is costly. And that cost is actually going to make the investors or the market believe that firms are going to actually focusing on R&D projects are likely to generate future economic benefits, for them to put those projects on the balance sheet, because there are subsequent impairment kind of monitoring mechanism there to make sure that those projects were going forward every year or periodically it will still generate economic benefit. Yeah. So that's kind of like the cost of the project level high quality signal. Yeah.
Okay. Yeah, thank you. Thank you very much for your info, the explanation. Okay, so now our setting. So our sample period is from
May I?
1990s. Go ahead, please.
I'm sorry, there are only so few of us. So what you should also consider is the ongoing research and development activities. And by that, what I mean is, as long as the firm continues to have R&D at the same levels or even increases, I don't know if it makes any difference whether you capitalize or not.
So, okay. So your question is about companies, a company they have more than one project, and how
They have
they decide. Okay.
they have ongoing projects, so every
Mm-hmm.
year they would spend $1 million that you have, or a little more every year. And if that happens, what are the implications? I mean, there's almost no implication to whether you capitalize or not.
So okay, so as I explained here, so in the Japanese setting, it is assumed that here, so it
I
is
think
assumed.
I can address that. So
Okay.
Joshua, in terms of the dollar value, right? We accountants tend to only focus on the dollar value. When you think about like $1 million or $1 billion of R&D spending every single year, expensing and capitalization has the same financial impact in terms of the assets and or expenses we are going to see from the balance sheet and income statement. But I think the focus of our studies, we try to take a look at what actually happened in terms of the quality of those innovative activities. We believe that R&D project actually very heterogeneous. For the same dollar amount of $1 billion, $1 million of spending, sometimes those are invested in a high quality project, sometimes low quality projects, and managers probably have that private information that external users or capital providers do not have. Even holding constant the dollar amount. I think our empirical model is actually try to kind of understand per dollar of spending related to the expense R&D versus capitalized R&D. How does that relate to the future innovation outcome? For example, patent citations, generality, but like the impact is not financial impact, but more about, we try to kind of draw some inferences on the quality or differential qualities across R&D projects, holding constant the dollar amount we spend. Does that address your question? Is that in terms of a dollar amount? Sure, it's the same, but we don't know whether that's the same type of projects in terms of quality.
Yeah, so you build into it more assumptions than just the dollar amount. You build into it variability of project successes. And again, I mean, it makes sense, but if a company has more than one project,
yeah,
that tends to be too average out. So I'm not sure. But let me be skeptical and let's go on.
Okay, thank you. Thank you very much for your question. And if I add something to Ayan's comment, and also covered by her, but our outcome variable do not include the financial ratios, the financial performance, but mainly the patent outcomes, and also the stock returns, as well as the interest expense or debt balance. So we are not interested in the financial performance at the company level. So, but yeah, I will cover them in a minute. Okay, so let me explain our sample period. Our sample starts in 1990 and ends in 2009. And we have a blank period between 1997 and 2000, because the accounting standards setter in Japan made an announcement of they start to consider the develop R&D accounting standard in 1997, which went to effective in 2000. Therefore, we consider this period as a transitional period, and excluding this period, we defined from 1990 to 1996 as pre-regulation phase, and from 2001 to 2007 as post-regulation phase. And as I explained, in the pre-regulation phase, there are alternative choices for companies, which means that companies could choose between expensing R&D costs on the income statement or capitalizing as long-term assets on the balance sheet subject to impairment. And in the post-regulation phase, the capitalization choice was no longer available for them. So therefore, our treatment companies are those that have recognized R&D related assets on their balance sheet in the pre-regulation phase, and our benchmark group are those exclusively expensing R&D cost even in the pre-regulation phase. And let me give you the setting in the very close, prior studies that have close motivation to ours. So which is the evidence from UK studies. So their setting is similar to ours in a way, because in the pre-regulation or pre-transition period from UK GAAP to IFRS, they had alternative choices, but that alternative choices are different from ours. So during the UK GAAP duration, the regime mandated expensing on R&D costs on the income statement does not change between UK GAAP under the UK GAAP and IFRS. But with regard to D cost, the development cost, companies had alternative choices between capitalizing and expensing. And in some prior studies, by Professor Zarwin's team, they consider the expensing development cost on their income statement in the UK GAAP regime as their treatment group, and compare the company with the companies consistently mandated expensing our cost on their income statement. So as such, the setting is similar, but in their situation, mandated capitalization of the cost is the outcome of the accounting standard transition. But in our situation, mandated expensing R&D cost is the rule that the new accounting standard required for Japanese companies. So in a way, the situation is opposite, I think. Okay, so please go ahead, Christina.
Hi.
Hi.
Yeah, I mean, just to clarify something about the UK gap situation, I mean, there was indeed a choice, but implicitly and sometimes quite explicitly, it was capitalization was discouraged and expensing was promoted. So we don't observe lots of capitalization for that reason. So I don't know if this is useful for you.
Thank you. Thank you very much for the input. Yeah, so I didn't know that, and so it is very important. So according to your explanation, companies and even in the UK GAAP regime discouraged to capitalize their D cost.
Mm-hmm.
Oh,
Yes.
I see. Yeah. So yeah, but in terms of the companies had alternative choices, Perhaps our setting may be comparable to theirs. And also for your information, it was not explicit in Japan, but as I'm going to share in a minute, the number of companies that recognize their R&D cost as fixed assets are relatively small. So therefore, as implicitly, companies may, for some reasons, in a way, discouraged to recognize R&D cost, or as I'm going to explain, so the doing so may be costly for firms because once they decide to capitalize R&D costs, it is subject to the public scrutinization and also impairment losses in the future. So if it's too costly for them, yeah, they may rather choose expensing all R&D costs in income statement. Okay, Ayang, so could you add something?
So I think, Christina, we appreciate you told us this because I think when we read Paul Tharon's papers, it sounds like, at least our interpretation is under the UK GAAP, that is the discretionary choices. But regardless, I think our setting is very different because our setting is from voluntary regime without any even like explicit or implicit pressure to a mandatory expensing that is very similar to SFS2. And when SFS2 was become effected in 1974, there was just not a lot of R&D firms or activities to document any effects. So that's why we view this natural experiment useful. But like whatever inferences we draw from voluntary regime to mandatory expensing is not going to be transferable to this UK regime, which is very different from what we are studying. Yep. I think maybe we can move on because I think this is just to show this setting is different from ours. Yep.
Yep. So Muskan?
Yeah, I just had a clarifying question. So you mentioned that pre-regulation, they could capitalize and expense at project basis.
Yes, project basis, yes.
Yeah. So I was thinking, is the treatment group then all the firms that had just capitalized all the projects, or were there like some firms which were capitalizing and expensing?
We categorize both as our treatment firms. So, okay, so let me show you this sample description. So in this sample description, we separate the total sample into two, benchmark group and treatment group. And in treatment group, we include two types of capitalizers. First is exclusively capitalizing R&D cost. So the other is firms both expensing and capitalizing R&D cost. So as you can see here, so the relatively small number of observations, so we decided to include both as our treatment firms. Yeah. Did I answer your question?
Yeah.
Okay, thank you. Okay, here. So let me move on to our hypothesis explanations. So the key for us is signaling. Okay, what kind of information the company signal by utilizing R&D accounting choices. Okay, first hypothesis is regarding signaling investment quality. For investing companies, it is a key challenge to communicate the quality of the project to stakeholders, especially investors. So innovation quality is largely private in the investing firms and varies greatly across project. And because of the attributes of innovation, it is very difficult to communicate the quality of the project in a credible manner. So therefore, especially investors face substantial ambiguity regarding the future returns of R&D investment. So however, there could be a solution if companies are given two alternative choices regarding R&D accounting. So which is capitalizing R&D as a signal. So building on Spence's signaling framework, we thought that capitalizing R&D can work as a signal regarding the quality of the project. So however, to make the signal credible, it should entail cost. And considering our situation, capitalization imposing costs through heightened scrutiny by the public, and also the risk of future impairment. And heightened scrutiny. Okay, so Peter, please go ahead.
Sorry, I didn't want to interrupt your flow. I was
No problem at all.
Well, I mean, it's really back to the project level accounting for R&D. In your capitalization regime, is there something that binds the firm to committing throughout the life of the project to capitalize or to expense, or is this a choice that can change as the firm learns about the quality of the project?
So once they decide to capitalize their R&D cost for a particular project, as far as they proceed, so they continue the project, they are required to capitalize the relevant R&D cost. And
Yeah.
only when they realize that the project is unsuccessful, they are required to impair the
I understand that, but the question is really whether the firm is required to account from time zero at the beginning of the project in a consistent way throughout its life, or whether it can, as is likely, I think, in many R&D settings, the uncertainty is gradually resolved over time as firms learn about, the progress made in the research in the early stages. Think about pharmaceutical development, for example. And if it's possible to start capitalizing when the uncertainty has been sufficiently resolved, then effectively what you might be at risk of picking up is not signaling, but just recognition of the value of some of the value of the project when the likelihood of future impairment under capitalization is lower than it would have been had the capitalization occurred from time zero. You see what I'm saying?
Yes, yeah, I could understand. So Iron, so do you have some response?
Yeah, so Peter, I understand what you're asking. I'm working on another project about M&A, and then we try to see those capitalized R&D or technology, what life cycle stage is. If for a pharmaceutical firm, is that the preclinical stage or FDA clinical trial 1, 2, 3 stage, or already upon approval? If it's a technology, NASA actually has this technology readiness level from exploratory level 1 all the way to level 9, when we can actually hop on the moon and then walk there, right? So I think the challenging here is we can see the capitalizing versus expensing, but we probably need to do a more detailed textual analysis on the patent filing to categorize those R&D projects associated with patent along the life cycle. But I understand what you're saying is that potentially it's very similar to the IFRS when R&D projects meet certain materiality threshold. reaching to the development stage, and that's the time firm starts capitalizing, because the likelihood of a future impairment will be relatively lower compared to the earlier stage project. And that's something we probably need to collect more data.
I mean, at a basic level, it also relates back to Joshua's point earlier that, you know, the project which you had in your stylized model having a 5-year life, was it? But you had the expenditure at time zero of 1 billion, whereas, you know, more realistically would be 200 million per year over the 5 years.
Yeah.
And at some point in time, the 200 million could become development costs rather than pure research costs when the uncertainty has been resolved sufficiently. And at this point, you know, capitalization could be equivalent really to recognition of development assets, knowing that the R&D costs are becoming more D than R at that point for that project.
Yeah, yeah, I understand that. I think that is kind of aligned with the software cost under the US GAAP that's 86 and then also IFRS. But for the Japanese regime, we don't know whether that's also is what firms has been doing without having some sort of a life cycle or materiality data for us to classify those projects into different stages. But
Yeah.
we can kind of like try to take a look at it if the patent filing allows us to classify it.
Yeah, so I understand the point, but I think what is important in the Japanese setting is that unlike the US or IFRS setting, so during that time, there are no clear accounting standards. So therefore, so the recognition of the company with regard to the successful rate of the project is can be arbitrarily determined. So considering that aspect, I think the capitalization can work as a signal because different companies may consider the successful rate in a different way. So in that sense, relative to the latest current accounting standards in the US or IFRS, there are still some room for companies to choose. So that's
I don't disagree with the signaling argument, except that I think that the firm has options over the timing of the signal, and its wish to signal could change dynamically. At the moment, your kind of model setup doesn't have any dynamics for the firm to learn in it, and that could be, you know, I think a more realistic way of representing the R&D activity, you know.
Okay. Yeah. Thank you. Thank you very much for the suggestion. Yeah. Okay. So Keishi, do you have a question?
Yeah. Can you hear me?
Yes.
Okay. Thank you. So I have a question about write-downs. So conceptually, I agree with you. So write-down risk can be a cost managers incur, but empirically, my question is how can managers record write-downs, because standard for asset impairments introduced in 2004 in Japan. So in the new pre-R1 standard period, managers do not have any specific standard for asset impairment. So I don't know the write down is a cost managers incur or not.
Okay. Yeah. Thank you. Thank you very much for that. The pointing that aspect. So actually, we we considered that aspect of so there are no relevant accounting standards for impairment during that time in Japan, and to show the relevance, or the how to say, the reliability of our assumption, we searched we searched some cases that indeed companies recognize impairment losses related to R&D assets. So there are only 3 cases here, but as these cases show, companies indeed recognize impairment losses related to R&D fixed assets. And those companies experienced stock price declines even after controlling for market level price movement. So the negative decline is between about 4% to 7%. So we believe that our assumption regarding impairment as a cost is credible even in the Japanese setting.
So so the write-down is related to the project shutdown or not?
As far as I can recall, so these are related to the termination of the project of a particular R&D activities. So for example, even
So
if
that's not the impairment, just a write-down of the write-down related to the termination of the project.
So okay, may I ask you the difference between write-down and impairment in that sense?
So impairment can be, so when firms record impairments, the project still ongoing.
Oh, okay, I see.
So that's the so in that case, market can assess the project, but if the project terminated, then market can assess the project. Market don't need assess the project anymore because the project is terminated already.
Tomomi, I thought we have statistics in terms of frequency of impairment, about 28%, right?
Yes, yeah. So for
I found
yeah,
the
so
collected data. Yeah.
yeah, hand collected data. While it was only for 1 year observations, yeah, but the impairment rate is about I cannot recall the exact number, 20 something
28.
percent. Yeah,
But I see that
28%.
we hand collected, that's only 1 year of data. I think 1996 or something is available, but like we check whether the ending balance of R&D assets from the balance sheet has declined, because assuming that those projects will be ongoing, so either stay the same or just has declined beyond the expected amortization
But
rate.
actually, we cannot tell that. So
I
it
see.
does not mean that the companies do not terminate the project, because it's a sum up amount.
Yeah.
So the companies perhaps terminate the project that that they recognize the relevant cost as fixed assets. So yeah,
The project termination is not something we can determine, but at least that's related to the capitalization choice. All we can observe is that capitalized asset subsequently was written down, right? So asset write down is related to the capitalization choice. Can be correlated with project termination or not. I think that's
yeah. So
project
yeah,
termination
all
is
in
not.
all, we cannot tell anyway. Yeah, based on the data.
But when we think about the incentives of Japanese companies, then I think the write down is related to the termination of the project. Otherwise, so managers don't have incentives to record impairments. Even so, if the project is ongoing. So
Yeah, so let me check the details. So I might be able to some impairment cases that while they continue the project, but they recognize impairment losses, to answer your question. Yeah, thank you. And Steve?
Yeah, it seems to me there's a need to distinguish here between startups and the mature firm. Mature firms have some reputational effects to take care of. A startup, you capitalize your R&D, you get the assets there, you get the investors in, and then everything goes to hell and everyone goes home bankrupt. There's a bit of a game to play there. You don't care about impairments. It's just a one-shot thing on a startup R&D. And that's different from a mature firm, which has got to actually think about its R&D stream.
Yeah, so you mean that for
the threat of impairment. The threat of impairment is not a big thing for a startup.
Yeah. So I agree. So it will be the case for startup companies.
So our samples are not. So like I think on average, our sample firms has been alive for 50 years. So most of those firms are established after World War II. So that's kind of like you can say the strength of the paper is that our sample is not based on startup, but a weakness of our result is that sometimes it's actually very different from the US market. That's where there are a lot of startups. There's a bankruptcy law to actually protect those startups to kind of like gamble. And also there's a very vibrant VC venture capital market to support those startups even before the listing market. But I think in Japan, for those listing firms in our sample, those are very established firms with an average age of 50 years.
And you've got to be very careful about extrapolating to accounting policy for all firms. It may be different accounting required for startups.
Yeah, this is the established firms, not startup firms. Yeah.
Okay. Yeah, thank you. Okay, probably nothing else. So the hypothesis one is about the project basis signaling emitted by the firms capitalize their R&D cost. And I already provided the cases, and so I would like to skip the slide. And our second hypothesis is about the firm level signaling emission regarding financial strengths. So which is more aligned with the evidence from the prior studies. So alternative signaling mechanism is R&D expensing. So which means that we consider both expensing and capitalization provides market signal. So R&D expensing can serve as a signal of firm level financial strength. So because immediate expensing reduce reported earnings, imposing a cost that financially constrained firms may struggle to bear. So this costliness can deter imitation, making expensing a credible signal of financial robustness. And the counterpart of the counterpart of the the signal receiver in this case is creditors. So in Japan, financial statements are central to bank lending decisions, and consecutive operating losses can disqualify firms from obtaining loans. So considering the intimate relationship between banks and the companies, especially Japanese companies, bankers may utilize their private information for their clients' financial strengths. Having said that, through the the informal conversation with bankers, we recognize that the bankers indeed utilize their financial statement, the client's financial statement, as a kind of first step filtering process. So, and according to them, so consecutive operating losses can be a trigger for them to downgrade their client from the highest level to the lowest or something like that. Steve?
Yeah, just again, this distinction between startups and established firms is very important. Banks do not lend to startups; it's all equity finance, okay? And probably because of this, you cannot take the R&D as a signal, okay? They just you can't. It's just too risky. Banks do not lend to startups, only to established firms. So the sector you're looking at is established firms. And so you've got to be careful about extrapolating accounting policy to all firms. In the case where you have established firms who have banking relationships, who actually the banks will lend to with a credible signal with its penalties to, that's one thing. In other situations, no, that's not on.
Okay, yeah, thank you. Thank you for the comment. So I think we should carefully explain our setting as Ian told you. So our research sample developed Japanese listed companies whose ages are more than 10 years or 15 years. So not only on average, but also at like say 25 percentile level, they are old enough to borrow money from their main bank. So yeah,
well, I'm just
so we have to
extrapolate.
carefully draw our setting. Yeah,
I'm thinking of extrapolating to the US. A lot of R&D is in startups. Okay, that's where a big slice of it is, and 90% of it doesn't pay off, and banks don't finance to them. Okay, so you're looking at a setting, and I wonder actually whether there's cultural difference too. Maybe there's relationships with banks and businesses that they actually more believable. In the US, we have a basic notion that the con is on. Okay, the con is on. You got to be worried about the con, and so there may be. All I'm doing is be careful about extrapolating to situations outside this very specialized situation with these firms with banking relationships, giving credit, and so on, to the general notion of actually thinking about capitalizing R&D under a lot of other conditions. These are very special conditions.
yeah. Okay. Yeah, thank you. And in a way, I think we may take advantage of the Japanese culture that has a very intimate relationship between bank and companies,
Yes.
and therefore it may strengthen our research setting. While there may be a trade-off because the relevance for the US setting can be smaller. So do you think, Ayun, you have any ideas about that?
No, I think Steve, we will kind of put it up front, like in the abstract beginning of the introduction, that this is a very unique setting, similar to our US experience, but this setting also very different in terms of the stage. Materiality of the firms will be more stabilized, and then also the external financing channels are very different compared to the US, more equity funding for younger ventures, and also with the presence of venture capital funding, it's very different external funding environment between these two countries. But I think we talk about it in the paper, but I think we need to put it more upfront when we introduce this setting.
Yeah, I guess just the general principles where you can get credibility to the signal. Okay, it's going to be different when you can't get credibility to the signal. And that's sort of the basic point here.
Yeah.
Okay.
Startup will be harder though. Like it will be harder to signal. Yeah.
Okay, Muskan?
Yeah, just reminder 5 minutes are left.
Okay, all right. So, okay, I already provided the two hypotheses we investigate, and I'm gonna skip the sample slide. So the one note is that we have two types of sample. One is full sample, and the other is constant sample. So to be included as as constant sample, firms have to appear both in pre and post period. So therefore, constant sample has smaller number of observations. So as I already shown this table, and so let me skip to the table 3. So this is the model to determine the capitalization of R&D cost. And as you can see here, the dependent variable is whether or not the observation is our treatment firm, the capitalized R&D relevant cost. So as you can see here, the smaller firm with a higher leverage and lower profitability are more likely to voluntarily capitalize R&D cost, which is consistent with our second hypothesis, which is signaling, firm level signaling mechanism with regard to their financial strengths. And our second table provides you with the quality of the project, and our outcome variable are twofold and patent quality metrics. And as you can see here, only the capitalized R&D has positive and significant correlationships with those patent quality measures. More specifically, capitalized R&D costs, not expensed R&D costs, relate to future patent citations over the next 10 years and technological classes per granted patents. For your information, these outcome variables are averaged citation and average class. Therefore, it's not influenced by the volume of patent application. And the next analysis is utilizes patent volume measures as the dependent variable. And for this specification, only expensed, not the capitalized R&D cost has positive and significant relationship. So expensed R&D cost, not capitalized R&D cost, relate to patent volume measures. And patent number of families means that they're international patent applications, not domestic. So both the applications has positive relationship with expensed R&D, so which is supporting our second hypothesis. So thanks to the signal of financial strengths, the companies could beef up their financial resources, and they can invest more in the project. Say it automatically somewhat automatically increase the volume of patent application. And so in this table, I show you the different depth comparison between accounting regimes. So after the enactment of the R&D accounting standard, which means the termination of the choice of capitalization of R&D cost, the company's behavior likely to be changed. So as you can see here, so the three-way interaction of total R&D cost, post and treatment, this three-way interaction shows you that after the regulatory change, total R&D costs for treatment firms relate negatively to patent quality measures, that in the pre-period, there was a positive relationship, but in the post-period, there is a negative relationship. On the other hand, it's a relatively minor, but the positive association between the total R&D and the patent volume measures. So which means that the capitalization firms behave similarly to expensing firms after the regulation change. So which is, we believe, consistent with hypothesis 1 and hypothesis 2. And the next two slides utilize annual stock returns and interest rate and bank loan and bond balance as our dependent variable. And as you can see here, capitalized R&D has positive relationship with contemporaneous annual stock returns. And bank loan and bond balance has a positive relationship not with capitalized R&D, but expensed R&D. So both of the results consistent with our first and second hypothesis. Okay, so all in all, as I want to draw to a close, I would like to highlight the two key takeaway, one key takeaway from our study. So our research provides compelling evidence that the way R&D is reported has a significant impact on innovation outcomes. Specifically, we've observed a clear influence on both the quality of patents and the overall volume of patenting activities. And this has policy implication as well, especially regarding the ongoing discussion around the recognition of intangible assets. Our findings underscore the need to consider how accounting practices can shape and potentially enhance innovation. And I think you may understand our contribution to the literature, I hope. So I would like to skip this part, but before I finish my presentation, I have to mention this announcement. Okay, so I'm excited to announce the call for paper for the fall 2025 Accounting Design Project Visual Workshop Series. So this research forum is open for people over the world, and those are invited to submit their work to this forum. So the submission deadline is September 2nd, 2025. You are required to submit your work via email to address displayed on the screen. Okay, thank you very much for your attention, and I'm happy to answer any questions you may have after this session. Thank you.